So here's how it's structured. The all-in-one loan is a mortgage security. We follow Fannie Mae standards, industry standards. It just happens to be a portfolio or proprietary product that we privately secure. So it provides the financing needed, but instead of being just a structured repayment plan, we instead engineered a first lien position, 30-year draw home equity line of credit. So we go from just a traditional mortgage that's has a fixed payment, and instead we open it up and say, let's make it possible for people to put money in whenever they want and securely keep that money available so they can take it out whenever they want over 30 years. Let's just start there foundationally. If you could put $1 towards your mortgage right now because you happen to have $1 extra today and your balance reduced by $1 today, that then offsets the amount of interest you're going to be charged. What if you have $100 or $1,000 or $10,000 just idly sitting around, right, waiting to be spent tomorrow or next week or next month, next quarter? Maybe it's just your rainy day fund. What if you could apply those dollars towards your biggest expense in life and keep those dollars available for future use securely? But in the interim, it will benefit you by saving interest cost on the mortgage debt in total. So that's the foundation of the all-in-one loan, is a 30-year draw home equity line of credit that can be used to purchase real estate or just refinance from a current mortgage and do this one. The line of credit is structured very uniquely. There is no balloon payment. There's never a structured P&I payment. Whatever the line of credit limit is that we establish and close the loan at, and I'll give you some parameters here in just a moment, guideline limitations. Whatever that amount is, it's established and remains unchanged for the first 10 years. After the 10th year, that credit line limit begins to reduce each and every single month by 1/240th. There's 240 months left in the 20-year ending period of the loan. And so we're going to take the original line amount, divide that by 240 months. And that's the amount of dollars that the line of credit the limit itself will begin to step down every month evenly over a 20-year period of time. And this is how we keep your money liquid. This is how we keep a customer's money liquid. Anything in between the daily principal balance and the line of credit limit is just available equity money securely in the line of credit, available 24/7 for use over the 30-year period of time. I'll go a little bit deeper into detail about how you can use it and things like that here in a moment. Some of the highlights, like I said, there's no balloon payment. There's no prepayment penalty. I still do believe today, to my knowledge, it's still the only 30-year draw home equity line of credit available in the United States. We allow loan amounts or line of credit amounts up to $2 million without any geographic limitations or restrictions like on conventional mortgages. And we make exceptions up to $3 million. And we're actually going to be expanding our guidelines officially up to $3 million in the near term. Again, it can be used as a purchase and also as a refinance. It applies to primary residences, second homes, as well as investment properties. So if you're a real estate investor or you have an investment property, maybe short-term rental property that you earn some income off of, this is a phenomenal way to finance that property and just drive your rental income, your revenue directly into the mortgage to reduce its balance. And I'll show you how easy that is and the additional features that come with a mortgage, because it's more than just a traditional or a standard HELOC. This also applies to single-family residences and multi-unit, up to 4 units. So 1 to 4 unit properties are allowed on this product. It does require decent credit, good credit score, 700 as a minimum and 720 for investment properties. We can go to 90% loan to value on a purchase or rate and term refi, 80% on a cash out refinance, and 75% for an investment property is a maximum. And again, we align with agency standards, meaning Fannie, Freddie standards for debt to income ratio, reserve requirements, things like that. I would say the one, primary characteristic that a borrower must possess to have a great success with this loan is just that you have to have some good cash flow behavior, live within their means, not a household that is living paycheck to paycheck and is struggling to make ends meet, maybe a heavy user of credit just to supplement their income and lifestyle. This is a product developed for people who live within their means, and manage their finances in this established way with some discipline, some level of discipline. Interest rates on this loan are not fixed. This is the paradigm shift. There are three things that matter when you borrow money. Only three. At the end of the day, there's three things that equate into the cost of the debt itself. And by the way, it's the same three variables at play when you invest money and you hope to grow the value of that money or the value of that asset. The same three variables. There's only three: interest rate, the term or time, and then the principal balance, right? If you're trying to grow money, we're all taught, invest, pay yourself first, invest with as much as you possibly can that you can afford, as frequently as you can do that, for as long as you can do that. Start early in your life. Start investing, building up your savings, building up, whatever your retirement funds. Start investing sooner, right? So we're taught that time matters and that your principal balance matters. What we do also know about investing money is that the market ebbs and flows. It rises and falls, right? So your yields are going to change over time. But what matters most is the amount of time you stay, committed to investing, as well as building up your principal balance. Conversely, think about managing debt. It's the exact same scenario, just kind of on its head. What matters most isn't the interest rate. What actually matters most is the amount of time you're in debt for and what you're doing with your principal balance. Again, are you dropping it fast, or is it going to stay high for a long time? If that's the case, even with your low interest rate mortgage, it's going to cost an arm and a leg in interest cost. You can have a significantly higher interest rate loan and pay significantly less interest and spend less time in debt. We chose not to create a fixed amortized mortgage instrument out of this product. Instead, what we chose to do is create a rate structure that is aligned with our own borrowing structure. When banks and lenders borrow money, they're not at fixed rates. They fluctuate over time with the market cycles. What we said is we set out to make a product that allows our customer to really, share that risk and the benefits of rates moving up or down. We do offer a 5-year fixed version. After the 5 years, it becomes a monthly adjustable. We also offer a 3-year fixed option. After the 3 years, it goes into a monthly adjustable. Or we offer just the straight monthly adjustable, 1 month adjustable. So we're not locking in the rate, locking in the payment. And I'll show you the payment structure of this loan here in just a moment. It's very unique, very appealing, much better. If you think about it, what good is a fixed rate and a fixed payment as the cost of living is increasing? As the cost of living increases with inflation, that means there's less and less and less residual money left over each month. So you're being squeezed. Every household in America out there is being squeezed because the price of gas is up, real estate is up. The price for a pound of coffee is up nearly 50% over the last 20 years. I mean, everything around us is rising in cost. So if you have a payment on your mortgage that's fixed over 30 years, you're still being squeezed. What's great about this loan is it provides an opportunity to reduce the amount of mortgage interest or the mortgage costs that a customer has to pay each and every single month. And in fact, reduce it at a faster pace than money is eroding away due to inflation. So it's a phenomenal product to use as a hedge against inflationary pressures and the expense of inflation, but also just simply to live a lot more independently, financially speaking. Most of our customers choose the 1 month option. It's a monthly floater, can move around. The index that we use is called the 1-year constant maturity treasury rate, or the CMT, AKA the 1-year treasury. Its historic average is right around 2%, so very low. That's why we chose it. It's very predictable. Rates are very competitive to conventional mortgages. So just keep that in mind. It's a competitive rate. The interest rate can fluctuate, but due to its entire design, your balance drops significantly faster. That's